Welcome to This Explainer. Okay, we're going to jump right in and dispel a massive, incredibly common myth right out of the gate. Liabilities aren't just bad debt that businesses should be terrified of. In reality, they are the absolute essential fuel for business operations and growth. But, like any highly combustible fuel, it has to be meticulously managed so it doesn't just burn the entire house down. Today, we're going to break down exactly how companies manage this very delicate balancing act.
Here is our roadmap for today. We'll quickly cover what a liability actually is, look at current versus non-current, run through a rapid-fire self-test, and then wrap up with why all of this really matters.
All right, Section 1. What is a liability?
So to really grasp what qualifies as a formal liability in the corporate accounting world, we've got to look at the baseline definition. The absolutely crucial point here is that a liability represents a financial risk that is entirely rooted in something that has already happened. It basically represents what a company owes to others. But you can't just slap any future expense on the balance sheet. The accounting world is way more rigid than that.
Notice the strict rule of three. An obligation literally has to hit every single one of these steps to officially become a liability on a balance sheet. First, it must arise from a past transaction or event, like, say, receiving goods on credit. Second, it's got to create a present, legal, or contractual obligation to pay. And third, it has to result in an actual future outflow of cash, goods, or services. If you're missing even one of these, it just doesn't make the cut.
Moving right along to Section 2, current versus non-current liabilities.
Now that we know what a liability fundamentally is, let's categorize them. And we do this based on a very strict ticking clock. This brilliantly illustrates the dividing line of one single year, which separates a company's short-term survival tactics from its long-term financial strategies. Honestly, this timeline dictates entirely how leadership manages their cash flow.
Let's look at the short game first. Current liabilities are basically your everyday operational obligations. We're talking accounts payable for your suppliers, short-term loans, the wages you owe your hardworking employees, pending tax bills, and unearned revenue. Unearned revenue is like prepaid subscriptions, where you've taken the cash but haven't actually delivered the service yet. These directly impact a company's short-term financial health and require constant, daily monitoring to keep the lights on and the business running smoothly.
Then, on the other side of that one-year dividing line, we have the heavy lifters. Non-current or long-term liabilities are absolutely crucial for financing massive capital projects and multi-year expansions. We're talking about long-term loans, bonds payable, property leases spanning decades, deferred tax liabilities, and future pension obligations for retiring employees. You don't have to pay these tomorrow, sure, but they are always looming on the horizon.
Okay, Section 3, the liability self-test.
Let's shift gears and actually put your knowledge into practice with a rapid-fire quiz. I'm going to give you a scenario and you decide if it belongs on the balance sheet. Scenario 1. A manufacturer receives a massive $250,000 shipment of raw materials and agrees to pay within 45 days. Think about our three conditions for a second. The materials are literally sitting in the warehouse, but the cash hasn't left the corporate bank account yet. So, what's your verdict?
It is absolutely a liability, specifically a current liability, known as accounts payable. Why? Well, because receiving those goods was a definitive past event that triggered a very real, present obligation to pay a measurable amount, and it's due well within our one-year window.
All right, how about Scenario 2? A company signs a massive 4-year, $100 million contract for a new superstar CEO who starts next month. The ink is dry on a legally binding, gigantic contract, but the CEO hasn't worked a single day yet. Does this $100 million promise count as a liability right now?
It does not count. This is a classic trap, honestly. It's not a liability because without the CEO actually performing the work, there's no past event or completed exchange yet. As of today, it is just a future promise. No service received means no liability recorded. Period.
Okay, Scenario 3. Customers sue a company for $5 million, claiming defective products. Obviously, this is a serious legal threat staring the company down, creating a ton of stress in the boardroom. But does a pending lawsuit automatically hit the balance sheet as a liability?
Not yet, because the final verdict is still totally uncertain. It lacks a measurable and probable obligation. The company might win the case or they might settle for a fraction of the amount. So it's kept off the balance sheet as a formal liability until a verdict or settlement is actually reached.
Let's pull all of this together. We'll summarize those scenarios and add a few new ones into the mix. If operations generate $2.5 million in estimated taxes,
Well, that's a current liability, because the taxable income was already generated. If your employees finish their work week, those $900,000 in unpaid wages are immediately a liability. And look at that last item, a $600,000 loan. The principal is a liability because you receive the cash, but that 9% interest? Actually, that is not a liability yet, because interest only becomes an obligation as time passes. It perfectly reinforces exactly how our strict rules apply in daily operations.
And finally, Section 4. Why do liabilities matter?
Let's slow the pace down for a second and look at the macro picture. Effectively managing these classifications dictates the very survival of a company, and it basically comes down to three major pillars of financial health. The first is liquidity. This is all about the short game. Do you have enough highly liquid assets like cash to pay your current liabilities right now? If a company miscalculates its current liabilities and loses liquidity, it's going to immediately struggle to pay basic bills like payroll and supplier invoices. The business just grinds to a halt.
The second pillar is profitability. Look, taking on debt to grow isn't free, right? It comes with interest costs. Leadership has to guarantee that borrowed funds are aggressively driving revenues upward. If debt is taken on but revenues fall, profitability absolutely plummets as those interest costs rapidly eat away at the profit margins.
And finally, we have solvency. This is the ultimate long-term stress test for any business. Solvency is all about ensuring that your overall debt doesn't completely overwhelm the company's total assets over the long haul. You really have to balance debt and equity financing to stay sustainable for decades to come.
When companies fail that solvency test, they collapse. Remembering the massive systemic bankruptcies during the 2008 financial crisis, where long-term debt massively outpaced true asset values, we leave you with this crucial question to consider for any business you analyze. Is debt being utilized as a strategic, calculated tool for growth, or is it pushing the business blindly toward a solvency cliff? Understanding exactly how to read the liabilities on a balance sheet is really the only way to find out. Thanks for joining me on this explainer. I hope it completely changed how you view the financial balancing act.